All right, Chapter 4, Accruals and Deferrals. So, because we do accounting under GAAP, accepted accounting principles, using the accrual method of accounting, we have what are called accruals and deferrals that we must consider when accounting for business transactions. And so we often have to do adjusting entries. Adjusting entries are needed whenever revenues or expenses affect more than one accounting period. Every adjusting entry involves a change in either a revenue or expense and an asset or a liability. The types of adjusting entries you can have are where you're converting an asset to an expense. An example of that would be where you prepay rent, so you record that as a prepayment of rent in your asset section. Remember that you expense it in the period where the rent's used. Let's say you prepay for next year. You're going to record that in the current year as an asset, prepaid rent, and then as next year accrues the months of the year, you're going to expense whatever rent expense is used up. So it goes from, you're reducing the asset, prepaid rent, and you're increasing an expense account called rental expense. You can convert a liability to a revenue. That would be where you've asked a customer to prepay something, and so you are going to record the receipt of cash, but you're going to record an obligation, a liability, and then at some point you're going to do the work or provide the good, and then at that point you're going to recognize revenue. You can accrue unpaid expenses. That's when you get a bill in one period and you're going to pay it in the next, so that would be accounts payable. You can accrue uncollected revenue. You come up to the end of the year, you've got goods that you've delivered, so you've earned the revenue, so you bill them as an accounts receivable. So again, converting assets to expenses the transaction here says you paid cash in advance of incurring an expense. So that would be your prepaid rent example. So you prepay the rent in 2015 for 2016. You're going to book that as prepaid rent at the end of 2015, and then in 2016, every month that you utilize rent, you're going to reduce your asset, prepaid rent, by monthly rent, whatever the monthly rent expense is, and then you're going to increase rental expense every month. And so the adjusting entry recognizes the portion of the asset consumed as an expense and reduces the balance of the asset account and increases the balance of the expense account. So the example they use here is $18,000 insurance policy coverage for 12 months starting March 1st through February 28th. On March 1st, in this example, Overnight Auto Services purchases a 1-year insurance policy for $18,000. So assuming they're on a calendar year end, well, first of all, they're going to book it as prepaid insurance, and then each month, as each month clicks off, they're going to reduce the amount of the prepaid insurance account for the amount of the monthly insurance expense that gets used up. So there's your initial, I mean, you could use unexpired insurance, prepaid insurance, it really, different names for accounts. It's not uncommon. There's no set rule for that as long as everybody in the company knows what it is. So initially, costs that benefit more than one accounting period are recorded as assets. Again, don't forget your explanation underneath the journal entry. So debit, prepaid or unexpired insurance, credit, cash. Notice when you make your entry for the credit, in this case cash, that you indent that. So it just kind of sets apart the credit, well, the account that you're crediting versus the amount that you're debiting. So, they paid this on March 1st as a prepayment. They book it as an asset. At the end of the month, they've used up 1 month's worth of the $18,000 prepayment. So it's a yearly prepayment. So they've used up 18,000 divided by 12, which is $1,500 for a month's worth of premium. And so at the end of the month, they make the following entry: debit, insurance expense; credit, unexpired insurance. So what that does is that increases the insurance expense account from 0 to $1,500 at the end of March 31st. It decreases unexpired insurance account, the asset account, by $1,500. And so the important point is that the costs are expensed as they're used to generate revenue. Again, this is all part of running a company. You might say, well, what's the generation of revenue here? You're trying to run a company and certain expenses are involved with that. And I suppose that the insurance premium is probably to insure their employees. Doesn't really say, but I'm going to assume that's probably what that is. So here's an example of how the unexpired insurance account went down, insurance expense account went up. Another type of prepayment that we have to originally book as an asset, and then as the asset subject to depreciation is used up, you expense the cost of the asset over its life. Now we'll get into this more in a later chapter, but let's just kind of give you an overview of this at this point, since we're talking about accruals and deferrals. Depreciation is the systematic allocation of the cost of a depreciable asset to expense. Well, what type of assets would those be? Well, property, plant, and equipment, things like that. So you let's say you buy a piece of equipment. You're not going to expense the cost of that equipment. It's considered a prepayment, and as such, you're not going to utilize that in 1 month. I mean, you buy equipment because it's going to last you a while, right? So you book the cost of the equipment as an asset, equipment, and you have to determine the useful life of it and expense it through depreciation over its estimated useful life. And so on the date when the initial payment's made, you're going to either pay with cash or on credit and eventually pay it with cash. You're going to debit the fixed asset account, in my example, as an asset called equipment. And as it points out here, the asset's usefulness is partially consumed during the period. And so you show this consumption through your depreciation expense. And so, and usually you don't do this every month, you do this like once a year at the end of the year. You're going to figure out the estimated useful life. You'll get some more practice at this, but we're just trying to get the concept down on this. I can't remember if it's 9 or 10 or exactly where we deal with depreciation, but we deal with it near the one of the later chapters, because there's different depreciation methods you can use. So each month that you use this asset that has a useful life of more than one period, you're going to debit depreciation expense, and then you're going to credit something called accumulated depreciation. Now again, we'll look at what this account is, this accumulated depreciation account. It's called a contra asset account, if you really want to know. Again, if you don't quite understand all that, don't worry. There's a lot more you need to learn before we get to that in chapter 9 or 10 or whatever it is. All right, so here's a little example. And it says here at the top, depreciation is only an estimate, because you have to estimate the useful life. You really don't know what the actual useful life is going to be. You just try to get as close as you can. So on January 22nd, Overnight Auto Services purchased a building with a useful life of 240 months for $36,000 using straight line method, which is one of the depreciation methods we'll talk about later. Calculate the monthly depreciation expense. Well, this, as you'll learn, this is not exactly a correct calculation because you have to figure estimated salvage value in this, but they're just kind of giving you a basic example. Using the cost, you would take the cost as your numerator and divide it into the estimated useful life of the asset, 240 months in this case. And so you would depreciate this building at $150 a month. And so on your books, what happens each month, the book value of your building goes down $50 a month every month. And this account called depreciation expense goes up every month through this journal entry. Again, you debit depreciation expense and you credit this contra asset account called accumulated depreciation, in this case, building. You identify which contra asset account this is for, in this case, for the building. Remember, depreciation is only an estimate. Here, Overnight depreciates it's $12,000 of tools and equipment over 60 months. So they're estimating a 5-year useful life. I mean, if you do this monthly, you're going to have to figure out the total number of months. If you just make your depreciation expense once a year at the end of the year, you just do years. So anyway, bottom line here is you would every month, in this case, in this example, depreciate the sum of 12,000 divided into 60 months, which is $200 per month. It says here, we will assume that Overnight did not record any depreciation expense in January because it operated for only a small part of the month. I guess you could technically do it for part of a month, but that's kind of a pain. And so, this is just showing the balance sheet presentation at the end of the year, taking into consideration the cost of the building less all accumulated depreciation that's been expensed for the year. So notice that this amount over here, or these amounts over here, the cost of the building less accumulated depreciation equals this thing called book value. So the book value of the building at the end of December 31, 2015 is $34,350. The book value of tools and equipment is $15,800. Converting liabilities to revenue, what's that all about? Well, that's where you collect cash in advance. Let's say, and when you're dealing with business to business type transaction, most of that's done on credit. So the customer is getting payment terms of 30 days, 60 days. We'll look at that here in the near future. But sometimes you you deal with a customer who just is not credit worthy. Maybe they're new, or they just don't pay their bills. In that case, if you want to sell to them, and they want to buy from you, they're going to have to do it on a CIA basis, meaning cash in advance. And so, let's say you come up to the end of a year and you want prepayment, you're going to deliver the goods in that next year or provide a service in that next year. And so what you're going to do when you receive that prepayment, you're going to collect the cash in advance of earning the revenue. You have to create a liability in the current period, which here shows as the prior period, because you're not going to earn it until that next year. And then you come up on next year, which is now the current period, and you earn the income by providing the good or providing the service, delivering the good or providing the service. You have to do an adjusting entry for either all or a portion of the revenue that you've earned that reduces this liability account. The liability account will be known as prepaid revenue or something like that. Unearned revenue is a popular term for an account like that. So you would book the cash as a debit. You would, with your original entry, you would credit unearned revenue, and then in the current period, when you earn the revenue, you're going to debit unearned revenue and credit revenue. So let's look at an example. Here we have a $3,000 rental contract coverage for 3 months that starts December 1. So it says on December 1, Overnight received $3,000 in advance of a 3-month rental contract. So what's going to happen is you're coming up to the end of the year. 1 year, looks like 1 year you'll earn in this December 1 month of that, and then in that next year you're going to earn 2 months. So let's see what happens. So originally or initially what they do is they book the cash receipt, debit $3,000, and they book unearned revenue, rent revenue, $3,000. Okay, so there's your liability. And then at the end of December, when they've earned the rent revenue, they back it out of unearned revenue, 1/3 of it. They've earned 1 month's worth, right? So they back it out of unearned revenue, and they recognize the revenue as rental revenue. Okay, so they earned 1/3 of that at the end of December. Now, what's left is $2,000 of unearned rent revenue in the balance sheet listed as a liability, but in January and February, as they earn it, they'll book this same entry. So that's what it looks like at the end of the year, December. This one's pretty easy. We saw this with our accounts payable. We purchased something on credit, and let's say it's a utility bill. We get a utility bill at the end of the year, it's for consumption of utilities during December, but we're not going to pay it till January the next year. So you're going to recognize in the current year an expense, utilities expense, and you're going to record as a debit a liability for accounts payable. It's a future payment. And then in that future period, when you pay the bill, you're going to back out the liability. So you're going to debit accounts payable and you're going to credit cash, since at that point you're paying the cash. So let's look at an example of that. Here they have wages that they're dealing with. On December 31, Overnight owes wages of $1,950 paydays not till January 3rd. So they're not going to pay that in the next till the next year, although they obviously owe it for this year. And so they're going to have to book wage expense as their debit for $1,950 for the current year, and since it's going to be paid in the future, listed as credited as wages payable. And so that's what we see here with this journal entry. And then when they pay it on January 3rd, they're going to back out the wages payable by debiting it. And then, of course, the credit would go to cash, since cash is being reduced. And here, of course, they're paying some more days in the month in that next year. So there's a little added twist, but that's not that big of a deal. So, total they're going to pay $2,397 weekly wages. $1,950 of it is before the year end, and $447 includes wages in the current year, or in that next year, if you wish. And so here's an example. We've not seen this before, but here is an example of what we call a compound journal entry. Compound journal entries occur when you have more than one debit and one credit. Here you have 3 entries you've made. You have 2 debits and 1 credit. And so anytime you have more than 1 debit and 1 credit, it's called a compound entry. And so you're having to, you've got a wage expense for the current month of $447. You've got wages payable that you're reducing by debiting it for $1,950, and of course the full amount of that is paid in cash, so that's your credit. Accruing uncollected revenue. You earn revenue by providing a good or service in the current year, but you're not going to be paid till next year. And so when that occurs, if you've earned the revenue, you have to book a receivable and book the revenue on the receivable. So your debit's going to be to a receivable account and your credit's going to be to revenue. And then, of course, in that next year, when you receive the payment, you're going to debit cash and credit the accounts receivable account. So let's look at how that works. So here on December 31st, Airport Shuttle owes Overnight half of its maintenance agreement. The 1 month fee of $1,500 is to be paid on the 15th of January. So they bill them. And here is the entry that they make. Accounts receivable, normally they'd have, you know, who that's with. That's why you have these sub-ledger accounts. So like the ledger account would be accounts receivable, and then there would be a sub-ledger account. And so the accounts receivable ledger account would include all receivables, but you'd have sub-ledger accounts for each customer you have. And you would go to the sub-ledger accounts to find out details on what a particular customer owes you. But probably the better thing to do here is accounts receivable dash ACE, or whatever the name of the company is, so you can keep track of this stuff. And so that's your debit, and your credit is to repair service revenue in this case. So you're booking the revenue in the period that you earn it, not when you receive the cash. And you increase an asset called accounts receivable. Let's say this company pays on January 15 not only the past service revenue they owe, but also revenue for the first 15 days of January. Again, we have a compound entry because they're receiving $1,500 of cash, but they already booked $750 of that in revenue for December, but they have not booked the revenue for the first 15 days of January. So what they have to do is break this out. For January, it's repair service revenue $750, and then they have to reduce accounts receivable by that $750 for the bill they accrued, the receivable they accrued for the prior year. Here's another example of accruing an expense. You have taxes that you owe, but you're not going to pay them till the next year. You simply incur the expense, income tax expense, and then create a payable. And then when you pay it the next year, you're going to debit the payable account and credit cash. Adjusting entries and accounting principles. Costs are matched with revenue in two ways. Remember the matching principle, that's what they're talking about here. Sometimes this is pretty easy, trying to associate an expense with a revenue, because there's pretty direct correlation. Sometimes it's not so easy, but you try to match up revenues and their related expenses is the point here. Of course, if there's a direct association of costs with the specific revenue transactions, I mean, that's pretty easy. For instance, sales rep salaries for the year. Well, that's directly correlated to the revenues generated for that year. So that's pretty easy to figure out. Others, not so easy. So like fixed assets, the equipment example we looked at, or the building in this case. There you try to match up expenses with the revenues by systematically allocating the cost of the asset over its estimated useful life. So that's a little harder to match. There's another concept that goes on in accounting, and that's the concept of materiality. You know, you're not always going to get the accounting records right. People make mistakes. Sometimes it's not a mistake. Sometimes people fudge the records intentionally. And so it gets down to this idea of materiality, especially, when it's something that's unintentional. I mean, if it's intentional, there's nothing you can do to stop somebody from doing something intentionally. I guess if you can fire them, get rid of them, and get somebody in there that knows what they're doing and will do it right. But, if the owners are going to materially fudge the numbers, there's not much anybody can do till they get caught. Anyway, this idea of materiality says that an item is material if knowledge of the item might reasonably influence the decisions of the users of financial statements. Many companies immediately charge the cost of immaterial items to expense. And so here, I guess the point of materiality or immateriality really boils down to, well, what items do we depreciate? What items do we not depreciate? Are we going to depreciate staples and paper clips? Well, no, we're really not going to do that, because that's just too much minutia in the records. And so, and plus we use those pretty quickly. Now, we might list those as supplies and, kind of go in there and, every year and look at how much supplies we've used, and overall supplies we might expense once we know we've used them, but we're not going to get into too much detail on that. And so, rather than capitalizing supplies necessarily and depreciating them, we simply at times go in and do a physical count and expense it at that point for what we've used. Take a look at this. I'm not going to get into this, but look at the effects of adjusting entries. Might give you some more understanding of how this works. Here again is the adjusted trial balance after all the adjustments are made to the ledger. And so after these adjustments, the ledger accounts are up to date, except for the balance in the retained earnings account. So we'll talk about that some more.